Hey traders, welcome to Charts and Coffee. Hope everyone had a good weekend, or at least a quiet one. Markets are open. It's time to get back to finding some trades, finding where the follow through is going to be. And that's exactly what we'll take a look at here this morning. We talked about on Friday, I did a free video on this. There was a channel, and the great thing is we get to talk about it, at least for now, in the past tense. There was a channel that had formed as of that move higher on September 19. And then from the 20th of September forward, right up until here, October 9, when we were able to break out through 58.30 on the S&P futures, it stalled out, had a little bit of an inside day, didn't sell off, just kind of stalled. Stalling is not the same as weakness. It's just taking a breather. And then on Friday, we launched higher. We closed above 58.30. And we continue to see the follow through. This looks very innocent, kind of bullish, but it's really not going anywhere. And it's one of those stealthy little price action things that we have to deal with and stay bullish, stay patient, and wait for the breakout. So most of what we did through this period was, well, a little frustrating because follow through isn't there. And that's what pays us, right? Fills get us in. Follow through is how we go and count. But when it's stuck in a range, this was approximately a 100-point range. When we're stuck in a range, it's frustrating because we know that we want to be buying, for the most part, those strong sectors, those strong stocks, heck, even the S&P. But the follow through that we saw from that middle of September forward wasn't at all like what we saw at the beginning of September to that midpoint. And that's where, when you step back and say, okay, we're no longer in chop, we're in a channel, and chances are we can still buy things. We want to make sure we have more time to expiration, things like that, little adjustments to make this tradable. We can set ourselves up to be long in situations like this when we're getting follow through. And here's the important point, gang, without taking inordinate risk to the account. This isn't about adding and rolling and max debit and buying something for $2 and letting it go to 20 cents, only to maybe let it go to $2.20 and say, yay, I made a profit. Traders do that all the time. So this is a really interesting thing. I've been thinking a lot about unrealized risk to reward, not just risk to reward, because a lot of times people will say, well, this is my stop and this is my target. And that's usually where risk reward comes from. What about how much we're letting an option devalue before we take a profit? Unrealized risk to reward. And I will tell you, traders commonly take 50, 60, 70, 80, 90% risk, and then we'll get out at 20, 30%. Now, I'm only using percents here. It could be you buy something for $1, you let it go down to 20 cents, and the moment it's $1.20, you get out. That's a backwards unrealized risk to reward. And I think when we talk about risk to reward, and I talk to other traders, sometimes it resonates and it makes perfect sense that we have to have a risk reward that favors our being able to grow an account, even if we only win half the time, right? Coin flip type odds. But I think what's happening because of this culture of max debit thinking, that it's perfectly acceptable to risk every dime of what you've paid for an option, that risk reward has really become in modern markets quite skewed. And this is where, and you might say, Rag, why are you harping on this? Because when I read emails and I read comments and when I see where traders are struggling, that's where they're struggling, right? It's either they strike out or they hit a home run. And it's just that binary. And that at scale is never going to work. Back to our happy news. Back to the S&P. Yes, we've broken out. Now, what's on its way to maybe doing the same thing? The NQ. This is right around this area of 20,550. In fact, I would keep an eye on 20,538 to say 20,550. And in that 12-point range, we're going to have not only the high of this this resistance we have there, but also the major psychological level that we'll likely have to contend with. So it won't be as simple as closing above 20,538, although that would be great. We really want to close above 20,550 to consider NASDAQ one of those places we have expectation for follow through. All right, that takes me then to semiconductors. Where are we here? This looks a lot like today. Now, this was Friday's candle. This looks a lot like that first break of the S&P on the 9th before it followed through on the 11th. This looks a lot like that. So keep an eye on the SMH. It too is trying to break out of that range. And this kind of brings us back to something. If you've been watching Charts and Coffee for any length of time, you know all year long, and most certainly since the Federal Reserve started solidifying their overall take on rate cuts, we're bullish. Anything less is casting into a smaller pond, and not even as good a pond. Anything else is top picking, because look, where does the idea that there's such a thing as the trade's gone too far? I was reading some interesting articles about, well, if a market makes an 8% move, it's exhaustive. Well, how often does that happen? Right? We're up 0.8% right now. We'd have to be 10 times higher right now. So people say, well, there are opportunities to play an overbought or a market that might be ready for a mean reversion. Okay. And let's say you find that magical percentage. How often is that going to happen? Often enough to grow an account? Probably not. Right? So this is where, yeah, there are some cool things that might happen on unique days that have very little frequency. I say the same thing about runaway up days. You know, when traders look at a runaway up day or a runaway down day and say, wow, what a great day of trading, it had nothing to do with us. It had everything to do with, we just caught a great wave. Sometimes it's a little bit of luck. And not often. You know, look, the difference between getting lucky all the time and, I shouldn't even say all the time, you know, kind of looking at trading as a little bit of luck, you had to get in, right? So that's the part where I'll remove luck. You needed a process to get in. But let's say the market only went 40 points. Great. You needed to take all you could. Entry to target, reasonable risk, get out. But let's say the market goes 140 points. Was that much better a trade? We really didn't know that was going to happen. And that's where, after we enter, a little bit of luck helps. Luck's not going to help you at scale in trading. But on those days that you follow your process and the market's just feeling more generous, whether that be SMH or gold or whatever. You know, for example, gold was very generous on the 11th. Was that luck? Not at all. What that was following the process to get in. And then in that overall expectation of higher highs, gold had a really nice move. So those are the kind of things that we want to differentiate. Crude's another one we need to keep an eye on. Crude's having a really difficult time. This right here is a really nice up day, and then it goes down. This is very common. This is very common price action in a chop that's not quite yet gotten above resistance that would change the way it's viewed to being more bullish. Right now, there's probably just as many folks who are bearish as bullish, and maybe more. That's the difference between being above and below particular levels. So that's kind of what we see right now as we're going through this early look, mid-October. And let's take a look at our questions coming in. I think we finally got a couple of them. All right. Francisco is asking about CLS. Clicks. Oh, Celestica. I don't know anything about this stock. It's at a higher high. There's really nothing to talk about there. You need a pullback. If anyone's been watching the show for any length of time, you know, gang, if we're sitting at higher highs, if we're trading up near the highs, there's absolutely nothing that I'm going to do at a higher high. I'll need a pullback. But even more so, let's talk about the difference between these two symbols. And this is a really good example of this. So thank you, Francisco. CLS is not really heavily weighted in any of the major sectors of the indices. I'm sure it's a fine stock, but a lot of times traders want to look at names that aren't tethered to the broader averages. The reason this is tricky, and RTX is not an example of that, but the reason this is tricky is It's going to move for its own reasons, however it wants. It's not necessarily tethered to risk appetite, risk aversion in the broader sense, in terms of, say, what the S&P would do. If I take a look at the RTX, now RTX belongs to the XLI. The XLI belongs to the Dow. And now I can see there's a nice hierarchy. There's an index sector stock. There's an alignment that I could look at from the Dow to the XLI to the RTX, and I can determine whether or not this has the possibility of following through because the tide is rising. I can also compare other stocks within the XLI to the RTX and say, hey, of all the things that I could trade in the XLI, would the RTX be the best? And in fact, it wouldn't. This is exactly the process that we do in the Sector Secrets Mastery. This is why our watch list is markedly different than pretty much everything else out there. Not that it's better, not that it's worse. I don't want to be that, I don't want to label it that way, but I do want to label it as alignment and follow through. It's solely built on alignment and follow through. Not this is my favorite stock, not this is always the one I look at. Most traders, and it's becoming blatantly obvious, most traders trade what they like, not what has the probability for follow through. And you might say, Rog, why wouldn't they? They know it. They like it. They have a good narrative. Maybe it paid them once upon a time. Who knows? Maybe they like the product. But it's amazing how much that bias becomes the watch list building process. I like the S&P. Even though the NASDAQ might be moving better, nope, I'm an S&P trader. Be careful what you label yourself as. I'm a Forex trader. I'm a futures trader. I'm a stock trader. I sell credit. I buy. Be careful, right? Because there are times it just won't serve you. And the worst way this organizes into a trading plan is I'm always going to trade SPX. SPX is such a great example. There are people that have SPX on the brain, and it's not for the better. Sometimes, in fact, the last 3 weeks, the SPX was really difficult. What was great? A lot of the things that we were trading in the mastery, gold, we're in Cisco. There are other things that are going to sometimes follow through. So if you find yourself falling into that trap, this is a really great way to break it. Is there alignment, and where's the follow through in this group? So GE, CAT, Uber, ADP, LMT, ETN, all of those would be trending names. UNP is an easy no. And then the next go round, RTX looks pretty good. Honeywell looks pretty good. Deere looks pretty good. UPS looks pretty good, right? But those the trending names that we definitely want to keep an eye on. And you'll see time and time again, Uber's doing it right now. Time and time again, you're going to see those past 3 weeks of that compression. See, Uber looks a lot like the S&P, doesn't it? A lot of symbols did this through that last, as soon as the Federal Reserve cut the 50 basis points by the 19th, 20th, things went sideways. I don't know why. And you know what? The why question, who cares? Sometimes we answer a question that really has no bearing on, am I going to trade this next? And how would I trade it? If we can't have it ultimately lead us to that question, it probably doesn't matter. Do I care why we were going sideways? No. I know the timing roughly. It does look like once we got the 50 basis point cut, a lot of symbols found a range. Okay, it is what it is. Now, as of Friday, we're breaking through it. And that's really what's exciting. And that's really what matters. And that's where if you were, I know I was bored, not as active and not as good follow through, and far fewer symbols to even consider. That should change, right? That should change. Okay, so thanks for the questions. When do a series of updates become a trend? It's on a matter of days, BLP. Thoughts on Meta for a swing long? Well, it'll be the same process. Is Meta the name that I want to look at within the XLC? Is Meta the name I want to look at within the QQQ? Are there names better than Meta? Not many. Meta is definitely something that we would look at for a swing. John, yes, absolutely. Meta would be a good swing candidate. It's got a trend. In fact, there aren't that many stocks within the NASDAQ right now. Again, if we're going to go through that alignment process, there aren't that many stocks that have a trend. It's very few. AVGO, Meta, NVIDIA, Netflix. 4 names, just 4 names. All right. Can we take a look at AEP? AEP is in the XLU group. It's one of the names that would be considered part of the conversation around utilities. AEP is the exact opposite of what you want to do with XLU right now. That's it, Ren. Ren, of all the things you could do, I'd keep an eye on XLU, but I wouldn't consider AEP a relative outperformer, right? Earl is asking, can I go over the arrows on the Darvis? Earl, just basically what it is. So for those of you that don't know what the Darvis 3.0 is, the Darvis 3.0 is an automated series of horizontal support and resistance levels, loosely, but mostly just inspired by Nicholas Darvis and the Darvis box. All right, so fast forward to modern markets and not wanting to be a 52-week breakout trader, right? What I wanted to do is find a way to have a process, right, a repeating process of finding those Darvis boxes, which were really just support and resistance levels. Once you take the sides off, so, okay, it's going to identify the ranges of, say, chop and channels. Cool. All right, then Darvis 3.0, the one thing that we did there, Earl, was simply we added arrows so that you could find the pattern within the pattern. And there's a pattern called a minor low and a minor high within that overall Darvis 3.0 pattern. And that's what the arrows do. All right. What about COP? So same process. Gang, we're going to go. Now, COP is going to be in a number of places, but let's just start with the XLE, for example. If we take a look at COP, heavily weighted in the XLE, the energy ETF. But again, where is the strength? Exxon, Chevron, Williams. Now, is COP a bad candidate? I wouldn't say it's a great one because it's still languishing below, at least for now, some resistance. And as I endearingly like to call it, the equator, the white dots of the top tier dots. It's a look at where price action is in terms of what obstacles it has above it. And obviously the dots themselves are an obstacle. The two Darvis levels there are obstacles. And the fact that ConocoPhillips would be seen as largely a little bit more bearish. I'd say the same thing about Chevron. Now, Chevron's probably got a better chance of busting up through, 152, 153 because it's got a trend. But unlike Exxon, which is already above the dots, right? So you see, that's actually really three interesting examples. ConocoPhillips, no trend, below the dots. Chevron, a trend, but below the dots. And Exxon, a trend, but above the dots. Williams is the other one that I would keep an eye on there. So ConocoPhillips isn't bad. A high tide could lift, raise all boats. That's certainly possible. But if I want to align my watch list to things that have the best probability of follow through, that's the process, gang, right? That's the process that we want to think about. So kind of going back to BLP's question, when would something become a trend? One of the things I would like to see, for example, with ConocoPhillips is getting above 114 and then printing enough green candles and seeing the participation to the upside to where ConocoPhillips could follow through in a way that Chevron has. But now, really to call Chevron a high quality trend, I really want to see it above the dots. We have the beginning of a trend, but I really want to see it above the dots. I really want to see it above basically 153. And then the follow through is likely to be much better because now when we look at the group of market participants, traders, investors, and what they're looking at, all of a sudden Chevron ends up on a bullish scan. It ends up on a bullish watch list. The sentiment, the opinion around Chevron will markedly change, much like the S&P finally breaking above that 5380 and this Darvis channel. What's happened? You can see it. The opinion change on the 9th. Little bit of maybe buyer's remorse, but not selling on the 10th. Folks weren't willing to say, gosh, I don't know that I want to buy at 58.30. Well, they abandoned all that on the 11th and up and away on the 14th. You see how the opinions change? You can see it after a long period of a compressed price action environment. All right, gang, that's a wrap. As always, thanks so much for being here for Charts and Coffee. I will see you all tomorrow, same time, same station. Be good to each other.